Hey everybody, James Pfeiffer with ACCU, and today, sensitive topic to talk about, and as you can see, it's the economics of small management. So today I want to talk about why I believe we see roughly 12 to 1 more RFPs for small communities than for mid to large size associations. At the core of this issue, it's a fundamental breakdown in understanding between small associations and professional management companies. There is a very common belief from boards and homeowners that small HOAs should be easy to manage. And that's because they're small. They shouldn't have a high management fee. Fewer homes, fewer problems, less work. That sounds logical. But in my experience and in the experience of many leaders in community association management, that assumption is just simply not correct. So let's take a minute to talk a little bit about the why. The size of a community does not eliminate the core responsibilities of professional management. Financials still need to be produced. Invoices still need to be processed. Vendors still need to be managed. Boards still need guidance, compliance support, and proper documentation. A small HOA still requires accurate financial statements, bank reconciliations, budgeting, reserve contributions, insurance oversight and regulatory compliance, and much, much more. The workload does not disappear just because a community is small. What does disappear? It's margin. Small associations often do not collect enough assessments to comfortably support both professional management and properly maintain the community. And ultimately, this is where the pressure begins between the community and the management company. It's pressure to lower the management fee, pressure to squeeze vendors, pressure to make it work with very little financial room. And that pressure, it largely lands on the manager. In many cases, it can triple the amount of time a manager spends trying to connect vendors with the community. Managers, they're forced to chase the cheapest possible option. Instead of using reputable vendors who understand the industry, know how to work with management companies, and have the financial stability to align the standard of accounts payables with the association's process. Small HOAs often chase lower cost contractors. On paper, that sounds smart, right? Yeah, I found a better contractor for less. In reality, it creates instability. Every time a vendor changes, management has to start over. We have to get involved and teach them how to communicate with the management company, how to invoice appropriately, how approvals work. And in small communities, this can easily increase, sometimes even 10x, the number of 1099s that need to be tracked and closed out at year end. So as we teach them how the accounts payable process works, that is not automatic. It takes time, and it happens over and over again. We have to continue to teach every new contractor that comes in. Many low-cost contractors simply do not have the cash flow to float more than like 10 to 15 days. So when payment timing slips in their eyes even slightly, first, they come knocking on our door, demanding immediate payment. Stop everything you're doing and get me paid right now. At that point, management, we have two options. We drop everything to solve their issue, or explain to them yet again the association's payment process. And that is often when they call the board. They complain and criticize management. They say, "This is the worst management company I've ever had to work with. I can't believe I haven't been paid yet. It's been 10 days. And now we're blamed. Reputations take a hit, and the association is caught in the middle, even though the issue is cash flow, not performance. Small communities have more visibility. Vendors know where board members live. Homeowners know each other personally. Issues escalate faster, and emotions run hotter and higher. Boards are closer to the day-to-day operations. That means more calls, more meetings, more conflict resolution. But again, not more revenue. For professional management companies, the economics, they're difficult. Staff costs don't shrink. Software costs don't shrink. Insurance, compliance, and accounting systems, those costs, fixed. So small associations are often left with limited choices. Large, low-cost companies that rely on add-on fees and unexpected charges, Companies that focus exclusively on small community management oftentimes have very strict contracts, like they should, or very lean operators with minimal overhead, which often means fewer systems, fewer controls, and sometimes fewer safeguards. These options are not automatically wrong, but they come with trade-offs. Smaller HOAs often face higher per unit insurance costs, greater risk when even one owner stops paying their assessments, oftentimes limited reserves, and very little room for mistakes. Small HOAs, they're not easy. They're fiscally tight, operationally sensitive, and reputationally exposed. The real challenge is not finding cheap management. It's finding sustainable management and properly managing expectations. In our industry, management, it's often treated like an all-you-can-eat buffet. It becomes we have a management contract, you do what we say or you're fired mentality. Managers burn out for little pay. Companies have to protect staff from difficult clients, and the boards feel the pressure trying to prove to the communities that they're holding down costs while still demanding a high level of service. This, more than anything, is why I believe we see 12 times the number of RFPs from small communities. And there's a solution, and it starts with the partnership. Work with the community to truly reduce the workload to the management company. But be honest when the association does not have the funds to fix certain issues. Put clear expectation memos out to the membership, explaining to them and protecting the image of the management company. And hold special assessment meetings and allow the owners to decide how funding shortfalls in major projects will be handled. If those measures, if they fail, they don't pass, it's not a reflection on the board or management. The community made that decision. Protect the relationship with a good management company. Work to understand the margin that they are working with, and do everything possible to allow your business partner to earn a modest, sustainable profit so the relationship can last long term. And most importantly, if there is mistreatment by a homeowner or a board member, put an end to that immediately, because that behavior doesn't just end one contract. It can drive another good community association manager out of the industry entirely. So, my name is James Pfeiffer. I'm with ACCU. This is meant to start a conversation, and so please let me know your thoughts below. Give me a call. Let's talk about it, or come on my show and let's have a conversation about the economics of small community management and maybe what we can do to resolve that issue, because it's a big one in community management. So give me a call anytime. My phone number is 303-733-1121. And until next time, I look forward to bringing you additional educational content. See you then.